Hello, everybody. I'm John Locke, and I'd like to welcome you to the LockeInYourSuccess.com Trading Performance Podcast, where it's all about real traders, real problems, and real coaching. Listen up and enjoy the segment. Can I briefly discuss my use of Fibonacci's? Yes. So Fibonacci, the way I normally use it in the market outlook is to project price pattern targets. So I'm just looking at the depth of the target. I'm looking at the depth of the pattern. And you notice mine are set up special. If I do a Fibonacci here, I only have 100%, which is going to be what I consider the neutral area of my pattern. I have a 0%, which is going to be the edge of my pattern, and then I have the 200%, which is my price pattern target projection, essentially. So that's the primary way I'm using these. This is somewhat different than directional traders, because directional traders will also do this, but they're also going to have oftentimes other lines put in. So if I edit my properties, most people are going to use a 32.8 and a 16.8 and sometimes a 132.8, depending on what they do. And they use these as support points. So one of the things that you'll see me talking about sometimes when we talk about technical analysis is that I'm looking for a 30%, either a 30% retracement off a price pattern target or a 30% amount of time to go by to become bullish again. So say the market goes overextended into a price pattern target. At that point, I'm expecting either a pause sideways or a retracement. The retracement I'm looking for is this. Okay, so, not that one. I gotta go the other way. Well, let's just do this in reverse. Let's remove this. Okay, I'm just going to activate this. I'm going to move it. And then I'm going to edit my properties. This is, I could have just checked the 160, the 1.68. What I'm essentially looking for is I'm looking for an overextension into a price pattern target, which then, let me draw something. I'm looking for, so I have this price pattern down here that kind of set in play. I got a breakout of that. I went straight to here. If I'm looking for, at this point, I'm going to be bearish, right? I'm going to expect the market to go down or run sideways for a certain amount of time. I will expect it to go down. If it goes down, I expect it to go down to here, at which point, if the market's very bullish, or if it's going to break out, essentially, if I get a positive reaction off of this point, then I'm covering my ass to the upside here, because now I have a high probability of this running up into a new level. Okay, that's your basic technical analysis, and that's what that's used for. The other thing that might happen is we might get something similar. We come down here, we have our pattern, we come up here, and we'll run sideways. At that point, I'm looking at thirds here. How long did this take to happen? If it took, say, 3 weeks to happen, then I'm looking for a 1 week move sideways, at which point, once again, the market should have consolidated enough for us to make our next move to the upside. So that's the basic theory behind that. But most of the time, you're going to see me using this solely to project price pattern targets. When we get to a market that's not hitting its price pattern targets anymore, then we can start coming in and bringing in some other Fibonacci lines to see, maybe notice if the market's making 50% of its price pattern target. If it's making approximately 35% of its price pattern target, what is it doing? And then you can then use the Fibonacci's to come in and use those for your directional and or movement opinions. So hopefully that makes sense.
And that is what I have for you today. If you have any questions or comments or anything else you'd like to see in the next Trading Performance podcast, please list that in the comments and I'll personally answer your questions and comments for you. Also, I'd love to encourage you to come on over to lockeinyoursuccess.com. That's LOCKE in yoursuccess.com, and check out our Trading Performance and Pro memberships, where you can find the tools you need to become a much more effective trader, regardless of the type of trading you do. Thank you for joining me. I look forward to seeing you on the next Trading Performance podcast.